Hey everybody, JD here with another Fireside Trader Masterclass video. Today I'm going to show you how to triangulate arbitrage trades using very simple mathematics. As you know, or maybe you don't know, you should know, I look at the market in a very unique way. Really, from my perspective, it's all about seeing patterns that others don't see, especially the algorithms. If I can get out in front of that, that gives me an advantage, especially in terms of intraday trading, that I like to use to turbocharge a portfolio, build a portfolio in our efforts to really build $1 million portfolio. So with that, what I'm talking about today is using expectations to target. What do I mean by that? Well, in this particular case, I'm looking at Wall Street targets for annualized returns for the S&P 500. In 2026, most of Wall Street is settled on a rate of return for the S&P 500 right around 10%. To keep things simple, I'm going to just call it 10%. Maybe it's 12%, maybe it's as high as 15%. For our purposes, let's just go with 10%. Now, what does that actually mean? There are 200 trading days, okay, in a given calendar year. If you divide 10% or 1,000 basis points of returns divided by the number of trading days, 200, what do you get? 5. You heard me right. 5 basis points on average per day gets you to your target. Now, as we all know, and you can see on this chart here, this is a one-year chart of the S&P 500, you can see how volatile the market is on a daily basis. It's that inefficiency that we are trying to, again, triangulate our expectations, our forecast for a given day. And I use this concept of annualized returns vis-a-vis daily average returns and compare that to, again, where the market is. You see, today, when I'm recording this video, the market, as I record, is down 55 basis points. That's a long way away from the 5 basis point average needed to get you to 10% annualized returns. Now, markets go up, markets go down, et cetera, et cetera, et cetera. Get all of that. And I'm not suggesting that a market should just move in a straight line by 5 basis points each and every day. All I'm trying to suggest is that this is useful information as you're looking at, for example, the last few days, a market that, by all estimates, is ahead of its skis in terms of reaching that annualized expectation of 10%. Even if you give it 15%, okay, you're talking about a daily basis point return on the S&P 500 that is well lower or higher than where the market trades on any given day. And you can see that today we're 55 basis points to the downside. And heck, it's been a volatile day. We've been well over 100 basis points lower. We were also 20 or 30 basis points higher at the open. So it's that volatility, again, that you need to keep in your back pocket and compare it to where expectations are. And if the market is getting ahead of itself versus what Wall Street expectations are, that's a clue. Again, doesn't provide all of the answers, but it's one piece of the puzzle that can help you be a better trader. And that's what we're all about here at the Fireside Trader. That's all I have for today, folks. This is JD for the Fireside Trader. Good luck with all of your trading, as always. I'll be back with another video. Tomorrow's podcast day, so won't be doing anything tomorrow, but well, maybe I will. Just depends if the topic that strikes a chord and I get it down on tape, I will do that. But for sure, back next week with more videos. Good luck with all of your trading, as I said, and I'll see you all next time. Take care, everybody.